Why did you make the call? Because fundamentally, you don't see your inflation and growth forecast changing.
Right. We didn't change our growth outlook. We didn't change our inflation forecast. We're still expecting inflation to start coming off these highs as we're moving through the first quarter of next year. And so if an economist doesn't change their forecast for growth and inflation labor market, then it must be a perceived change in the Fed's reaction function. And we think that's what we've seen. We think it culminated with Chair Powell's remarks in his testimony, where now they're clearly putting price stability first. So that's up on that pedestal, whereas before it was maximum employment. Now they're going back to that old historical relationship of price stability will beget maximum employment. So let's focus on price stability first. So we think that did confirm that they are going to be much more sensitive to these higher inflation numbers that are persisting for longer.
Ellen, is there a recognition that the Fed is behind the curve? Do you think that change of tone we've had from Jay Powell?
Well, it's a good question. I think that there is concern, especially among a group of FOMC participants. I think Loretta Mester put it succinctly to me when she said, look, we are quickening the pace of tapering, which we expect to be announced at this coming meeting next week, in order to finish tapering early and give us the optionality should we need to move more quickly on rates. Now, have they decided exactly when they'll move rates? No, they'll take that decision as we're moving through the data and getting possible evidence early next year, whether inflation is going to continue to run hot or whether it's going to start coming off those highs. But you need the optionality, and every central banker ultimately wants as much optionality on policy as possible. And so I don't think faster taper is signaling that they're going to turn around and hike right away. But I do think that they want to be prepared and be more nimble in case that is an action they need to take.
Ellen, to our sort of question of the day in terms of, are we looking, did the number today come in a Goldilocks way? Why you're seeing stocks spike, why you're seeing yields fall? And I wonder if there is some truth to that, in some of the individual categories, we know the prices are going to roll over. We know energy prices are off the highs, and they've already rolled over. There's some softness, relative softness, in used car prices. Do you see that as a possibility?
So I could see why markets reacted the way they did. I mean, I did like some of the things that I saw in the report. It is much too early to declare victory on the narrative that inflation will slow. Even though that's our view, we don't think we get it until we're probably midway through the first quarter. But it was certainly encouraging because the weakness that we're looking for to build is in that core goods category. So where inflation has been driven up the most, representing supply chain bottlenecks, I am seeing it. Very nascent signs of it. If you really dig around in some of the data, in the Fed's beige book, in some of the comments in the ISM, if you scrub earnings transcripts from companies and look at some of the early pipeline inflationary pressures, you can see it. And it usually takes a few months to start to show up in final goods prices. And so I think this is the start of building evidence, but I think much too early to declare victory.
Ellen, I'm sitting here wearing a yellow jacket. I'm at one of the most advanced and automated logistics sites on the planet. Nestle, GXO here have invested heavily in robotics. Basically, they're trying to get in front of this problem. When do you think we start to see capital investment significantly picking up in the US to try and deal with some of the bottlenecks that we're seeing right now?
So I think we are seeing some of that. I mean, one thing that we've called this a global COVID CapEx cycle, because I think COVID has been a catalyst for capital deepening. It's not just about taking the existing technology we had and making more use of it, because we already had the capability to speak like we are now. But it's more of the going further and putting in place new technology to drive efficiencies. One, we've been seeing a very tight labor market drive up wage costs. And when labor costs are rising, it tends to be a precursor to capital deepening. And in the US, we've seen it most pronounced in IT, so in tech, and in equipment. And so I think that we're seeing the strongest capex cycle in the U.S. now since the 1940s. And I think that there's every reason to believe that will continue.
Ellen, before we let you go, I just want to go back to the Fed for just a moment. The market's looking at about 70 basis points of rate increases for next year. So you're still below that. What kind of numbers and what kind of category would we have to start to see for you to get a little bit more aggressive on your call, a little bit less okay with the fact that inflation will roll over at some point?
Yeah, so it's a great question. So I think as we turn the corner into next year, I want to see that we're continuing to get evidence of the pipeline of inflation slowing, so that I have confidence we are going to see it at the final goods level, finished products level for households, so in the CPI. But it's not just evidence that inflation is slowing. I need to see the chair get the markets to focus on that. If he says nothing in the first quarter, even as inflation is slowing, the Fed always takes the path of least resistance. If they think the market has it right, then there's no job for them to do, and they'll let it ride. And so that would be an indication to me that there is the appetite from the Fed to go ahead and start hiking earlier than we expect. So it's both about the data, but the message from the Fed as well.